Hello and welcome to everybody who's logged on today. I can confirm that the interest in this webinar has been absolutely phenomenal, and we do have people logged on from across the world. The subject matter today is, of course, it's a very powerful financial tool and something that for everybody that I've spoke to personally, you know that I'm very passionate about. It's, of course, life cover. Now, for those who have just been introduced to the Carrick Group as a whole, in a nutshell, we are an award-winning financial advisory and wealth management firm. I am proud to say that we have just won Best Advisory in all of Africa at the most recent 2022 awards, and we are quite proud about that fact. Now, we specialise in creating personalised financial plans around the client's individual needs and goals. And when it comes to these personalised plans, I firmly believe that the most important part of this jigsaw puzzle of this financial plan is life cover. And that really is down to the fact that it acts as the ultimate protection for both you and your family. And when it comes to building long-lasting generational wealth, it is the #1 tool. We only work with the largest and most trusted financial institutions, which brings me nicely on to our speaker today. He is the Vice President of Business Development at Continental, Manish Sharma. Thank you.
Thank you, Christy. Thanks a lot. Pleasure to be here.
Thank you. Thank you. So I believe we'll start the presentation now. Could you just tell us a bit about yourself, Manish, just before we go into this?
Yeah, thank you very much, Christy. Again, very happy to be part of this forum, and because as you said, you are most passionate about this work. Even I'm also passionate about securing families, providing protection to family, businesses, and their loved ones. I'm doing this work for last 23 years, and that's my profile. Basically, I've been into the banking and insurance field for last 23 years, worked with giants like HSBC, Citibank, ICICI, and world-renowned insurance companies like Max New York Life. And currently, I'm based out in Mauritius and providing solutions to 150 country nationals across the globe. So major chunk in the African market, sitting from Mauritius, because that's the nearest area. But then there are no boundaries now. So we provide these solutions to 150 country nationals all over the world. So that's what I do personally. And moving towards today's agenda, we will going to talk about this unique solution, which is called universal life, or we can call it jumbo insurance or high value life insurance, which is a very unique solution for the HNI and ultra HNI segment. And why universal life is a better solution compared to other available solutions in the market, which is term insurance or unit link whole of life insurance solutions, which are the providers who are providing these solutions, then how it provides a complete protection solution for families, individuals, businesses. We're going to talk about that. Then can it be used as a collateral for loan or mortgages? We'll talk about that, and how this helps in legacy and succession planning. We're going to talk about that in today's discussion. And then definitely the floor will be open for question and answers if you have any query and all. So moving forward about high value life insurance, let me give an insight why high value life insurance is required. So people say life insurance is a need, and definitely, let me put it, it is one of the important things which everyone should have. I'll be surprised if someone of you say that I don't have a life insurance or I don't need it. Really, I'll be surprised of knowing that, because I've met thousands of clients in last 23 years, those who initially said that there's no need of life insurance. I have a lot of liquidity and everything. But seriously, they came back and said that, please, can we go ahead with this solution or any life insurance solution which is more prevalent to them based on cost and everything. So first basic purpose of this insurance, which is jumbo insurance or universal life insurance, is for legacy and succession planning. So if you have noticed the invitation of webinar, it has written a liquid asset. So when we say liquid asset, basically this policy helps as an asset for you, but in liquid form. So it helps in legacy and succession planning. You can take this solution to provide legacy for your next generation, because all the assets which you have is used as a legacy. Today you are using it, maybe something you have inherited from your previous generation, and in your case you're using it, growing it, and later you will transfer it to your next generation. It is used for that purpose. Succession planning is basically you have 2-3 kids, or your wife is there, you want to do succession planning in case you are not there tomorrow. This can be used as a tool to do proper succession planning, which I'm going to talk with you in some of the examples in later slides. Then comes the wealth preservation. Wealth preservation is basically you have built your wealth, maybe inherited, or maybe the first generation business, or maybe through your salaried income. You have grown your wealth in form of liquidity, in form of illiquid assets, properties, other items like cars, yachts, so stables and everything. People own those kind of things. You don't want that in case something happens to you untimely. So your family has to dig out in that wealth to live their future life, to maintain their lifestyle. You don't want that assets to be sold, because you have built those assets with some kind of a thought that you want to transfer it to your next generation. So why not to create some liquidity that in case something happens like that, your wealth is secured as it is, and that amount which comes from this solution can be used as a future lifestyle maintenance, financial support, anything. Then comes the inheritance tax planning. Now, inheritance tax planning is one of the important aspects to understand. This is for people, those who own properties in jurisdictions where there is an inheritance tax, like UK. There's a 40% inheritance tax, that in case something happens to the person who owns the property, to the property to be claimed by the legal heirs, a 40% tax to be paid by to the government. In South Africa, it is up to 25%. So different jurisdictions have different tax liabilities. So why not to take a solution which takes care of the tax liability in case you are not there, and the family is not burdened with taking care of the tax and pay and then claim the property. So this solution can help in creating a solution to mitigate the risk on the tax liability. Then key person protection and business continuity go in hand. Suppose you have your own business, and you are the key person. It could be a family business where multiple family members are the key person in the business. It could be a partnership firm where there are 2 partners who have contributed and hold certain shares in the business, or it could be an individually owned business. So you can be a key person of the business, and you don't want that in case something happens to you, the business should struggle for the liquidity crisis. So these solutions can provide that liquidity to the business in case you are not there tomorrow, and the business runs smooth as it is until they find out another key person to maintain the business in the same manner. It can happen with family businesses also. For example, family business, there are multiple family members, let's say 4 or 5 family members who holds key position in the business. Something happens to one person, most of the family don't want that the share of that person to go to some third party who is not related to family. So what will the family do in case of the demise of that person? They will sell out the share. Now, to buy out that share, you need money, you need liquidity. Now, if you have to take out the money from the business, definitely it will going to impact the working capital of the business. Why not to take a solution in name of the key person? In case something happens, the money comes from the insurance solution. That money can be used to buy out the share. That money can be used to pay the civil package to the family, or that money can be used to maybe to settle down some mortgage if that person has taken on behalf of company. That money can be used to maintain the working capital of the company. The company can decide what can be done with that money. So business continuity, why it go hand in hand with key person protection? Because that money can help in continuing business as it is, and the business should not struggle in case of there is a demise of key person which is untimely. Then charitable giving is for people those who have reached to certain stage. They are not looking to further grow their empire or further add further cash to their wealth. They're looking for charity. So these policies can be assigned for charity purpose, and in case of the demise, the money goes for the charity they have decided. Now, these are some basic purposes of taking this kind of a solution. And who is suitable profile for taking these kind of solutions? So to start with, high net worth individual. Many of you could be high net worth individuals, could be working, could be having a business, individual business, or who has just set up a business and earning a decent amount of income. So you are the right profile for taking these kind of solutions. Business owners, it can be individual business, partnership business, family-owned businesses. They are the right profile for taking these kind of solutions. Then family with illiquid assets. Most of the time you'll realize when you earn money, you start investing into the assets like properties, which is one of the most loved asset worldwide. People like to buy properties, and no harm in doing that. But the thing is that in case of a requirement, the family struggles for liquidity, and it is not easy to sell off the property immediately and liquidate it. In case you are not there tomorrow, your family needs cash liquidity. It's not easy to sell the illiquid assets. What can be properties, jewelries, racehorses, yachts, vintage car. So why not to create one asset which is liquid in form of this solution? Then global property portfolios. People like buying property, and people like buying property worldwide. I have seen families owning properties in UK, in India, in South Africa, in Mauritius, and different parts of the world. The biggest challenge comes is when you have to either sell off those properties or maintaining those properties by paying the taxes. So in case of the sudden demise of the person owning the property, this property becomes a headache for the family to maintain or to square off. So these solutions help in mitigating the risk of taxes or creating a liquidity for the family. So people, those who have this kind of requirements, definitely it is one of the best solution for them. So if you think any one of you fit into this kind of a requirement, please reach out to us. We can create a customized solution for you on that. Now, what are the key benefits of these kind of solutions, which is high value life insurance solution? One is that this is available in 150 countries. Whichever part you are resident, doesn't matter, we can provide this solution. Subject, it should not be a sanctioned country or a high risk country. So you can discuss with us, where are you resident? We can provide this solution. No need for you to travel to certain countries to sign up these solutions and all. No, within your countries, we can provide these solutions to you. Another best part about this solution is there are accumulated guaranteed values in the policy. So in case there is one part is the life insurance, the another part is the cash value, which you can access in case of financial requirement. So tomorrow, if you have a financial requirement at any stage, you can encash the money from your policy, which I'm going to talk to you in the examples. Then sophisticated underwriting and high capacity. High capacity means we can insure people starting from $1 million up to $200 million, which in world, there are hardly 5 to 6 companies which have capacity to underwrite that kind of a solution, which is up to $200 million for individuals. We can provide these solutions. So that's why it is sophisticated underwriting. We can even insure people starting from age 20 up to age 85. So where most of the insurance companies stop providing solutions above age 70, we can go up to age 85. Recently, we have covered a person at age 75 for $65 million cover. So because he wanted to provide liquidity to his family and want to leave a decent liquid asset for the family, he took that insurance. Then another challenge you might have seen if you have inquired about insurance. So if you are smoking, the rates are quite higher. But here we have solution because there is a flexibility. Even if you are a smoker today and you commit to quit smoking, so you may be charged a smoker rate in year 1, but if you quit smoking 1 year time, you can be shifted back to non-smoker rate. So that kind of a flexibility is there here. And then flexibility in terms of premium payments. You have choice, you have freedom to decide how you want to pay your premium. 1 installment, 2 upfront, want to change it, want to increase it, want to decrease it. Those kind of flexibilities are there in this policy. Then some of the key features I will talk about briefly. So suitability is basically for high net worth individuals looking for high value life cover. Age eligibility, as I said, 20 to 80, but we can even go up to age 85, subject to underwriting. For kids, we can offer between 10 to 19. If family is looking, husband and wife both are covered and they are looking for their child, we can provide that solution for them. Sum assured, as I said, it is ranging between $1 million to $200 million. And there's an open-ended term. The best part about this policy is you are covered till the time you are alive. So, so many people are there attending webinar today. One question, if I ask everyone, do you know your date of birth? The answer from everyone will be yes, we know our date of birth, because we know when we born, our parents have told us, but none of us knows our date of death. Why? Because that is uncertain. We don't know when that will going to happen. We can't control our death. So now what happens when we don't know? So it can be today, tomorrow, it can be beyond age 100. Some might live up to age 100, some might live beyond age 100. So most of the insurance companies, they provide cover up to specific age, whereas this solution says you are covered till the time you are alive. Alive means one thing is certain, which is death. When? We don't know. So this policy says whenever it happens, the cover will be paid to the beneficiary, either individual, either family, either company, either family trust, whoever is the beneficiary, this will be provided to them. So if you'll ask me, is there any specific age? Yes, which is 121 years of the person. Now, I have not seen anyone living up to 121. That's why we say you are covered till the time you are alive. Then there are inbuilt guarantees on the policies. There's a credit rate of 4.1% for first 3 years. And then there is a minimum guarantees on the investment side of the policy, which is 2% minimum. Availability into 150 countries, as I already explained. Flexibility, as I already told, you can pay in one installment. You can choose to pay for 2 years the premium. You can choose to pay for 5 years, or you can choose to pay up to age 100. You have that kind of a flexibility in your hand. There's one option also there, which is premium financing. The premium can be financed by banks or by financial institutions. But I will not going to talk much about the premium financing today, because the current market, the interest rates are not that lucrative that we talk about the premium financing, because it has reached up to 7.5%, which is not the right time for the premium financing. Once it comes down back to 2.5%, then definitely we're going to come to that kind of a discussion where premium financing is possible. Then another flexibility is about the surrender. If you want to surrender your policy, do you have access to your cash value? Yes, you have. After 10 years, there is no surrender charges. First 10 years, there is slight surrender charges, which keep on reducing year on year. First year, it will be higher. Then it will keep on reducing up to 10th year. And then from 11th year, there is no surrender charges. You can partially surrender your policy to have access to your cash value, part of your cash value, or you want to surrender full. You have access for your full cash value, which I'm going to show you in the quotation we'll discuss. Then value interest accumulates in the account value. Policy remains in the force even till there $1 left in the policy. Policy can be increased, decreased, which I'm going to show you in further slides. Then there are guaranteed return exposures. There's a protection towards the market fluctuation, because the investment happens through S&P 500 index. So let me move to further slides. I'll show you the values so you can understand it better. So now the investment, I was talking about the how investment happens in this policy. So investment is mirrored with S&P 500 index. Now, why S&P 500 index? Because S&P 500 index is one of the safest index worldwide, which is index of top 500 companies of US, where the performance, if you go on last 25 or 30 years of history of S&P 500 index, you can Google it, the Wikipedia, you will see very minimal years are there where S&P has performed negative. So otherwise it has been positive. Even in COVID times, you have seen that it was only negative for 1 year, then it has bounced back. So that's the performance, because if this top 500 companies collapse, so you can understand what will happen to the worldwide industry, worldwide financial industry. So this is one of the safest index. So these insurance companies, they mirror their investment component with S&P 500 index. Now, there are many solutions where you can invest in S&P 500 index. but then you are risk prone towards the performance of S&P. But here, being an insurance solution, insurance company cannot take a risk on the insurance side. So what they have done, they have capped the performance. So they say if S&P performs negative in any particular year, client is not participating in negative return. So they have capped the minimum performance at 0%, and maximum they have taken it up to 9% or 9.18% depending on the solution. So in case the S&P performs more than 9%, you will get maximum 9%. So insurance company, they bear loss in case of negative return. They recover their losses if the return is more than 9 or 9.18%. Currently, what they are paying is between 6 to 6.25%, between 6.18 to 6.25%, which is average of year to year. And there is a minimum guarantee of 2%, which is basically in case client is looking to partially surrender the policy and that year the return is less than 2%, insurance company is committed to pay minimum 2% on the investment side. So you have that kind of a flexibility and safety in this policy. Moving further, which are the two insurers who provide these kind of solutions with whom we are working, and we are the direct distributor for them? So they are Manulife and Sun Life International. Both are Canadian companies. Manulife, to be specific, is 134 years old in the business, and Sun Life, to be specific, is 153 years old in the business. Both are originated from Canada, and for their offshore business, they have an entity in Bermuda from which they serve the 150 country nationals. Both are regulated by Canadian authority as well as Bermuda authority. And talking about the security and safety, which can be turned by the ratings they have got from all the rating agencies. So if you can see S&P, Moody's, Fitch, AM Best, they are highly credit rated. So one of the peace of mind that is the insurance company safe? Yes, they are safe based on how you judge the safety of an financial institution, by the rating they have and by the stability they have in the business, how many years they have spent in the business. Because 100+ years means they have seen pandemics, epidemics, situations like COVID, wars and everything. Still they are sustaining this business because of this solid credit history. Now, this is very interesting slide and I love to share with people, those who understand little bit of insurance or investment side. So whether you have to do an investment or whether you have to do an insurance which is linked to market, what happens when you pay the money for investment? You have to use some platform, like you're using any platform for investment. So what that platform will do, or like, for example, you pay money to bank and ask bank to invest on your behalf. What bank will say to you, Mr. or Mrs., you have paid me this much. My charges for the investment is say 1% or 2%. I will take out my charges, the balance money I will going to invest for you. Now that money grows, good luck. That money doesn't grow, your bad luck. But here insurance company says, when you pay us premium, we will invest full amount in S&P. That amount will grow, then we're going to recover the charges out of that, which is cost of insurance, which means you are getting higher returns. And then, so let's put an example. You paid 1,000 rupees to a bank and 1,000 rupees to this company. So what bank will do? They will recover 100 out of that and then they will invest 900. So that 900 will grow. It will take time to become 1,000. Here you pay 1,000, they will invest 1,000, that 1,000 will grow, then they will start recovering their cost of insurance out of that. So here the investment growth is higher. Now, how these policies are done. So because now, as I said, you don't have to travel to any part of the world to sign the documents at all. So what they have done, they have created a trust arrangement, which is free of cost by Manulife and Sun Life both. Whoever insurance you are choosing, there is a free trust, master trust solution. So there's a master trust, you will be the insured. You can choose your beneficiary in the policy. Beneficiary can be individual, beneficiary can be company, beneficiary can be your family trust. So being in your country, resident in your country, staying in that country, you can opt these policies through the free structure provided by these insurance companies. Then yeah, this again, the next slide, which I'm going to show you, again interesting, which will show you the difference between other types of insurances available in the market. So there are three types of insurances now. Universal life we are talking today in this webinar. Then there is unit link whole of life, Now, what is unit link whole of life? Unit link whole of life is basically an insurance solution which is linked to the market performance. So you might have taken these kind of solution where the advisor says to you, okay, Mr. or Mrs., you are taking this insurance and the premium is getting invested into the stock market, the funds you have chosen. If the funds grows, good luck. If it doesn't grow, your bad luck. Then there is term life. Term life is a pure insurance. There is no investment component in the term life solution. It is like your car insurance. If something happens, claim is paid. If nothing happens, thank you. So now, if you need to understand the difference between three, coverage for life, in your universal life, it is you are covered till the time you are alive. Whole of life basically covers you up to age 100 maximum. Term life, it depends on how many years you are choosing to cover yourself, 10, 20, 30 or up to age 100, depend on you. Adjustable death benefit here, this is interesting. In universal life, depending on your life cycle, suppose today you are opting for a cover for $1 million. 10 years down the line, your financial status has changed and you realize that, okay, $1 million is not enough depending on my liabilities, my family, my business. I need higher cover. Can you change the cover in this policy? Yes, you can increase your cover, maybe 2 million, 3 million, 5 million, 10 million, or you can reduce the cover up to 1 million if you have higher cover. But in other two policies, there is no flexibility. What you have chosen, you can only go for that. You cannot change the cover. Same thing, fixed premium required? No. Here, premium is flexible. In other two, whatever insurance company will tell you the premium, you have to keep on paying for that number of years. Here, it is flexible. Yes, we will tell you what will be the premium today, but you can increase that, decrease that, based on your financial outgo. So suppose your premium is $10,000 and you say, okay, I have $15,000. Can I pay? Yes, you can pay. So your premium term will keep on reducing if you keep on paying higher. Or if you say, okay, today, this year I cannot pay 15,000. Can I pay half? Half I'll pay next year. You can even do that. But you can't do same thing in other policies. Then flexible premium allowed. As I said, yes, it is allowed. You can even skip the premium, which is called premium holiday. So if you have an existing insurance, try to check with your insurer that this year I cannot pay the premium. They will say your policy will going to lapse and you will not be covered, which happened with many people during COVID times. Because during COVID time, there was a havoc, earnings were less or even zero, but expenses were there, whether school fees, whether other medical expenses, everything, household expenses were as it is, whereas the income was reduced. Now, at that time, most priority for people was to take care of their family instead of looking for their life insurance. Now, if you have not paid premium during that period and something had happened to the client, insurance company will not going to pay the claim. Whereas here, there is a flexibility which you can opt for premium holiday. Okay, this year I'm not paying premium. Can I pay next year? Yes, you can do that. You are still covered for full amount, which is called premium holiday. You can choose for, okay, I can't pay premium for 2 years or 3 years. You can even do that. You are still covered. Subject that you have paid your premium for first 3 years on time and your policy has become self-sustained. So till the time there is $1 left in the policy, you can opt for premium holiday. So that kind of a flexibility is there in this plan, which none other insurance company provides. Then credit minimum rate, there is, yes, minimum credit rating is like 4.1% or 4% depending on the plan you're choosing. In other two policies, there is no credit rating. Then cash value growth, yes, there is a cash value growth based on the S&P 500 index performance. In whole of life also, there is a cash value growth, but on the funds you are choosing. If fund goes down, there is no cap at 0%. You have to participate in negative return. And in term life, there is no cash value growth. Then can you take loans? Yes, against the cash value, you can take up to 90% loan. Interest rate will be decided by insurance company at that time. Then can you make withdrawals? Yes, you can make withdrawals out of your policy, definitely partial or full. If you make full withdrawal, the policy will come to end. If you make partial withdrawal from your policy, your sum assured will be reduced with the equal amount. So for example, your cover is $2 million and then your cash value is $300,000. You say, I need $100,000 out of my policy. Yes, you can withdraw $100,000 and you will be covered for $1.9 million from there. So that kind of flexibility is there. Cash value transparency, as I told you, you can easily calculate the performance of S&P 500 index, average it, and you will get same here. Whereas there is no transparency in the whole of life because it is linked to the stock market, and term life, there is no cash value at all. So I hope you understood the difference difference, why universal life is different from other life insurance solutions. If you have any questions, please park it and you can raise it at the end of the webinar. Now, moving, both insurance company globally accepted, high growth rate for quotes, higher cap on performance, downside fully protected, no rebalancing. Like if you have selected funds, you have to keep on putting mind into that, when to switch the fund, if it has grown, to shift it to the balanced or growth or conservative. Here, nothing to be done. Insurance company is taking care of everything. No fund selection, nothing, simply track S&P 500 index. That's all. So that's the simplicity here. Now, I'm just sharing one example with you. For an age 45-year-old resident in Africa, non-smoker, and choose to pay for 20 years. That I'm deciding, okay, I want to contribute my premium for 20 years. You can say I want to contribute in 2 years. You can do that. You say I want to contribute in 10 years. So depending on client to client, you have flexibility to choose your own premium payment term. This is just an example. So I'm giving example for $1 million as well as $2 million cover. So let me show you here. So for a $1 million cover, for a 20-year premium funding, non-smoker, the premium is $16,200 a year. Now, another best part here to understand is that this $16,200 is a standard rate. Now, if you see here, standard non-smoker, if your health is good, based on your medicals, everything is normal, this premium can further go down. You might get a standard plus or preferred or super preferred rate. So your premium might go down by another $1,000, $1,500. So this is just for the purpose of understanding what could be the base premium. It can further go down. It can go higher also if health is not good and if there is a loading. It can go higher also, but all depends on your medical reports, which we will going to arrange for you. Then if you see now, to understand, in 10 years you have contributed $162,000. And in 20 years, you have contributed $324,000 for $1 million cover. After 20 years, your future premium is nil. So you don't have to contribute any single penny after 20 years, but you are covered for $1 million till the time you are alive. So one thing is guaranteed, that whether I have paid $16,200 or whether I have paid $324,000, in case something happens to me, my beneficiary will going to get $1 million guaranteed. So one thing is secured here. Now another portion comes is the cash value, which I was talking to you. So if you see, in 20 years time, you have contributed $324,000 and the cash value is 270. So if I just calculate it, 324 minus 270 divided by 20 years divided by 365, at a cost of $8 per day, you are providing $1 million security to your family, which is cheaper than even a meal for a day for a family. You can't get a meal at $8 for your family in a day. Whereas at $8 per day, you are providing $1 million guarantee to your family. So which means, so in case you want to surrender the policy also after 20 years, the cost on your pocket was just $8 a day for next 20 years. So in a way, you were covered for free, putting inflation in place. Now, let's say, which is 20 years I'm talking, 30 years down the line, when you are 75 years old, you come and say, I took this life insurance policy for my family to provide family security because I had liability. My kids were small, my business was there. But now I am 75. Everyone is well settled. My kids are earning. They have taken care of my business. My wife is there with me. I have retired from my business. My kids are looking. Nobody needs $1 million in case I'm not there tomorrow. I need money today to live my balanced life and I want to maintain the same lifestyle. Who needs $1 million in case I'm not there tomorrow? I need money today. You can surrender the policy. The value in 30 years time is around $410,000. You paid only $324. You can withdraw this money and you can use it for whatever purpose you want to do. Or you come and say, okay, I don't need $410,000. Can I withdraw $200,000 out of here? Let the policy run. Yes, you can withdraw $200,000 out of this and you will still be covered for $800,000. Not necessary for life, depending on how many years a policy can run with that $200,000. Have that flexibility. Or you say, I don't need this money. I have taken this $1 million. Let it continue. Whenever something happens to me, my family will get a liquidity of $1 million. And if you live beyond 800, Luckily, many people do that. So if you live beyond age 100, you get more than $1 million as a cash value, because at age 100, you have $1 million as a cash available in the policy to withdraw, which becomes equal to your cover value. Same thing for $2 million. If you see $32,300 is paid, and same thing keeps on growing. You have just contributed 300 and so in this case it will be, sorry for the mistake on the calculation, 32,300 into 20, you will be paying $646,000 instead of 346. You will be paying $646,000 in total, and the guaranteed coverage is $2 million, which is a safety for the family or for a business. You can even do that. Okay, this policy can be taken by individual. You can pay premium individually from your bank account. You say, no, I have a company which wants to take a policy in my name, and company will pay this premium. Yes, you can do that. You can even decide the beneficiary. You want company to be the beneficiary, or you want your family to be the beneficiary and company only as a payer. You can even decide that. Or you have a family trust. You say money will be paid by my family trust and the beneficiary will be my family trust. You can even do that, and it is transferable. So that's again a flexibility here. Now, another thing to understand is the guaranteed coverage mentioned here, assuming 2% growth rate. So which is a guaranteed 2% growth rate in the policy. This 45-year-old person is guaranteed covered up to age 79. So what does this mean? This is basically, let's take a hypothetical scenario that you have taken this plan and it is linked to S&P 500 index. Now, the day you have taken this plan, S&P 500 remains negative throughout the life of the policy, which will not going to happen. That's why I said it's a hypothetical scenario. Why? Because if you take out the history of S&P 500 index, it has hardly remained negative for 1 or 2 years maximum. But being an insurance policy, we should think about the hypothetical scenario also. So we say if S&P performs negative throughout the life of the policy, in that case also with minimum 2% growth, if client has paid for 20 years, guaranteed covered up to age 79, guaranteed coverage. So which is a peace of mind, which is another 25 years, 24 years, in fact, not 24 years, more than 24 years. So 79 minus 45, 34 years, there is a guaranteed coverage that in next 34 years, something happens to client, 1 million or 2 million, or whatever the cover amount is taken will be paid. And it can be further continued by paying extra premium. But then this scenario will never going to come, because some years it might be 0%, some years might be 9%, some years might be 6.18%. Average is 6. What insurance company is paying year on year. Now, as I said, segment cap rate is 9%, which is on the higher side. Lower side, it is 0%. There is no surrender penalty after 11th year, as I explained to you. It is tracked by S&P 500 index, and there is a segment started. So now, if you understand dollar cost averaging, so little insight about that, how these policies are more secured, because the premium which you will going to pay either 16,200 or 32,300, insurance company doesn't invest immediately full amount. What they do, they create 12 segments. So, and this, they divide it into 12 equal installment, and every month they invest it. So what happens with that? So this month, suppose they have invested, S&P has performed negative. Next month they have invested, S&P has given 5% return. Third month, S&P has given 8% return. Fourth month, S&P has given maximum 9%, then 0%. So what happens with this? They average of last 24 months, 12 months, and then they pay the interest. So with this, the risk of investment goes down drastically. That's why it is called dollar cost averaging, and they invest in 12 equal installments. Now, these are few examples to understand, which will maybe fit into some of the clients, and these are real examples which we have explained to clients and which has fit in well with their lifestyle and all. So let's take an example, family and business protection planning. David, 45-year-old non-smoker, lives in East Africa, who runs his own business. He needs life cover for his family and business protection, which is worrying him that in case something happens to him, his business will going to struggle, his family will going to face liquidity challenge, because entire money is invested in business. Now, he can't afford to take any unnecessary risk or vary of stock market fluctuations, because let's take an example. You have invested, people might say, oh, I have investments, I have invested my money in this company, I've invested my money in these stocks. Now, something happens to the person. And actually that time, like similar situation, Russia has planned an attack on Ukraine, or there is some other kind of an issue, or there is a pandemic and markets are down, and the family needs money at that time, but it is not even equivalent to the money what you have invested. It is not even up to your capital. So family is facing risk. So he don't want to take any stock market fluctuation risk based on the environmental fluctuations. So he plans to take a $1 million cover with this policy with a balance index that he don't want to take much risk. And then he plans to surrender the policy at age 75, deciding there are nil liabilities on him because everything is settled. Now he wants to relax. So he took $1 million cover in an anticipation if something happens to him before age 75, his family receives $1 million. He's paying $16,200 per month. Total, he's contributing $324,000. Now, nothing happened to him. He plans to surrender the policy at age 75, planning that there is no further risk. He wants money for himself. He gets $410,000 back. He paid $324,000. So in a way, he's getting his money back. Or to simple way understand, with whomever banker you are banking, the banker comes and says, Mr. X, you keep $16,200 in your savings account every year, and we guarantee if something happens to you, we will pay $1 million to your family or business. If nothing happens to you, you can take back this money. Yes, if you withdraw early, it will be a little lesser than what you have contributed. If you withdraw later, it will be higher than what you have contributed. So this kind of an example might fit into some of you people's lifestyle. So if you need more details, please reach out to us. Now, this is another example of, I was talking about legacy and succession planning at the start, why people take these kind of policies. So John is a 50-year-old person, has two sons, David and Will, lives in East Africa, and he has an established business which is valued at around $2.5 million today. Now, his son David is associated with the family business and he's running his business, but Will is pursuing his passion, which you'll find in many families. Not necessarily all the kids want to be part of the family business. Someone is following passion. Sorry. So he wants to follow a passion of musician and he don't want to join family business. But as a father, as a head of the family, when you are doing a succession planning, you have to divide your assets equally between your kids. So John's worry was that if he gives 50% of the business to Will, it will be unfair for David because David is the only person who is running the business and David is growing the business, whereas Will is not even putting 1% of his time into the business. So what he does, the solution provided to John was that he should take a $2.5 million cover in his name and assign the policy to his son Will, who is following his passion, and assign the full business to his son David. Now, in case of demise, David gets full business and Will gets $2.5 million, which is the benefit of the insurance in case of John's death. Both are happy. David is happy because he's running the business. He has. Will is happy because he got liquidity of $2.5 million. He's also happy. Now, there might be a question people asking, okay, business is valuated at $2.5 million today. The business might grow. The value might increase. So the solution is that, as I said, there's a flexibility. You can evaluate your business every 2 years. If business has grown, you can increase your cover with that much amount. So that flexibility is there. So John pays a premium of $57,200 per year for $2.5 million cover. Total, he chose to pay for 15 years. He's paying $858,000 and guaranteed of $2.5 million will be paid in case he is not there. Or he wants to surrender the policy at age 75. He has $1 million. So that kind of a flexibility is available in the policy. So which might fit into, there are many other examples. These solutions can be customized as per your need. And here John says, okay, I don't want to pay the premium. Let company pay the premium. Can be done. John says, no, my family trust will going to pay the premium. And the beneficiary in the trust is Will, John, everyone. And I have given instructions to my family trust who will receive what. That can also be done. So you have those kind of flexibilities here. So this is on the presentation side from my side. And I leave the floor open for questions and answers. Thank you very much.
Thank you, Manish. That was very informative. We do have some questions through. So question number one,
Please.
I feel like you've already answered this, but just for the case, why do you call it a liquid asset?
Yeah, so this is an interesting question, Christy. So what we mean by asset? Asset is basically part of you until you don't sell it off and until you don't square it off. So let's take an example. Business. Business is your asset. Okay. Until you don't sell part of that, it will remain with you. Talking about properties, you bought a property. Property is also called your asset. So until you don't sell it off, until you don't transfer it off, it remains with you. Same thing, you purchase cars, jewelry, yachts, race horses. So all these are your asset, but all of them are mostly illiquid. That means liquidating them, you might not get the similar value what you have invested in that, or it's difficult to liquidate. Suppose it's a property and something happens to the key person in the family. Family needs liquidity. Now, it's not that, okay, you have your own house, perfect. You have your business, perfect, but a life can run further with cash, which is liquidity. Now, selling of a property is not easy, or selling of a car, you might not get that kind of a value. Selling off your race horses, yachts, and anything, it's not easy. So this policy is also an asset, but in liquid form, because as said, it will stay with you until you are alive. So one thing will come in the picture, that in case something happens to you at any age, family will get liquidity, or other thing else, whenever you want to surrender it, then you will get the liquidity. So that's why it is called liquid asset.
Thank you, thank you. So on to our next
Welcome.
question.
Please.
If something happens and I cannot pay, what happens with the policy?
Yeah, so as I said, there is a flexibility, and this happened with many people during COVID times. Now, there are two ways to look at it. There is a financial challenge, and you cannot pay for certain number of years. So you cannot contribute the full premium, you want to contribute half. You have flexibility. Instead of paying full annual premium, you say, okay, third year I have challenge, I want to pay only half of the premium, half I'll pay later. You can do that. Or you can opt for premium holiday. Okay, next 2 years or 3 years I can't contribute, I'll start contributing from the 4th year onwards. You can do that. So the policy runs as usual. Another thing is that you cannot pay. You have contributed for 10 years, and then you come and say, okay, I was supposed to pay for 20 years. I cannot pay further at all. So there are two options. One is insurance company can tell you at that time that you have contributed for 10 years and you are not contributing for that 10 years. Your policy might run maybe up to next 20 years or 30 years without further contribution, and the cover will come to end at that time. Or you can decide to surrender the policy at that time and take the cash value, whatever is available at that time. So you have that option.
Yeah, nice. So on to our next one. Quite a good question, this one. How many beneficiaries can you have in one plan?
Infinity. So the answer is infinity. Why? You can choose to take one beneficiary, two beneficiary, 10, hundreds, but you have to justify the relationship with the beneficiary. What is the purpose? You can't appoint your neighbor as a beneficiary. How you will justify the reason of taking the beneficiary? It should be a blood relation. When you are talking about the family, it should be a relation. If you're appointing any company, there should be an insurability interest within that company. So you must be a director of that company or key person of that company. Or if you're appointing family trust as a beneficiary, there should be an interest. You must be a protector or settler of the trust. So you cannot appoint any third person who is not related to you as a beneficiary. But you can appoint any number of beneficiaries. Suppose you have your 10 legal hirers, you can distribute percentage between them, that my wife will get 20%, my other kids will get 5% or equal. You can do anything, and you can change your beneficiaries anytime during the policy and number of times.
Very impressive. So on to our next one. We've got a little bit of time left. You have answered this, but I think it's worth touching on again. Can I make withdrawals from the policy?
Yes, you have full flexibility in the policy. You can make withdrawals, which is partial or full. So whatever your cash value is there, if you want to withdraw 10% of that, 20% of that, you can withdraw. There is some kind of so many people have taken these policies when they got married. They took their policy because it was cheaper at younger age, and it is always advisable to take an insurance at your early age because it will be cheaper. But then that doesn't mean that if you have not taken at that time, you should not take now. You should take, because there is no substitute of insurance. So people have taken that, and when they had a higher education requirements, they withdrew some fund out of the policy. They paid for the higher studies of the kids and then continued it. So you have flexibility of partial withdrawal. I won't advise to surrender full because your cover comes to an end. But if there is an emergency, you can even do that, or you can even opt for loan from the policy, which is up to 90% of your cash value.
Nice. And then we'll have to be really quick because that's our hour. So for the last question, another
Please.
very good question. Can I transfer my insurance to another person?
This is a very new feature in the policies, but the cover has to be minimum $2 million. So where as a family member, okay, as a key person of the business, I have taken this policy, okay, where my company is paying the premium, and I have enjoyed the cover, and now I'm 75, I'm retiring from business, my son is taking care of, my daughter is taking care of the business. I can transfer this insurance to my son or my daughter. They can get covered from there onwards. So the best part here is that I have taken a $2 million cover with the value with the premium, but they might be eligible for $10 million cover with the amount available in the policy. Or you can continue with $2 million cover and withdraw the balance amount of the money from the policy. That flexibility is there. Even forget about this is family we are talking. Or I have taken a policy $1 million. Tomorrow I want to transfer this, $2 million. I want to transfer it to my daughter. I can do that. And another interesting part is if you have taken it as a key person. So one way of key person is it's a family related business. Another way of key person is a hired key person. So suppose you have a business where you have hired a CEO in your business, and that CEO is very important person because his brain is running that business. You don't want that something happens to him, business struggles. So you take this policy in that CEO name and company pays the premium. But 3 years, 5 years down the line, that CEO plans to leave the job and moves out, and the new CEO comes. Company can transfer that policy insurance from previous CEO to the new CEO. So you are not losing out money out of that. So these are some new features which has been added in this policy and which is very unique, not available with any other insurance solution.
That is an incredible solution, especially for, like you said, for building generational wealth and passing it down the line each time. That's incredible. Manish, thank you very much. We should wrap it up there.
Thank you.
Our hour. But yeah, thank you.
Thank you, Christy.
Incredible presentation.
Thank you very much, and it was pleasure meeting here and providing this solution. As I said, I love providing family protection and solutions to people because it is a kind of a social service, and one of the social service where we get paid for sure. But joking apart, it is very important for everyone to have a solution. Investment, you might get many opportunities to invest. Maybe today, maybe tomorrow. If you're alive, you can multiply your wealth. But think of the scenario. If something happens untimely, we don't reach to our family this night, what kind of a challenges they may face? What challenges my business may face? So we need to provide solutions for that. And depending on your financial capacity, start your cover, increase it, decrease, you can do that. But the important aspect is get yourself covered today. Very important. Thank you from my side.
Yeah, thank you, Manish. If any of our registrants, if anybody would like to know more, feel free to get in touch with me at any time. I can always arrange a quick one-to-one with yourself and Manish, and then we can really tailor a tailor-made solution just for you. Thank you, everybody.
Sure. Thank you.
Thanks, Manish.
Have a good day. Bye.
Cheers, you too.